10 months, consecutive green closes, a record that has never existed before in silver's entire market history. And yet, not a single headline, not one mainstream anchor, not one primetime segment. They crashed it, they sold it, they called it dead, and still, it closed green every single month. Now ask yourself one question. What do they know that they don't want you to know? The data is speaking. Most won't hear it, but you're about to. Welcome back to John Analyst. Now before we go any further, if you have been with this channel for a while, you already know what kind of work we do here. No noise, no hype. Just the data, the structure, and the truth behind the numbers. And if you are new here, think of it this way. You would not walk into the most important business meeting of your life without preparation. This channel is that preparation every single time. So if this is your first visit, subscribe right now, not tomorrow, not after the video, now. Because the kind of information we are about to discuss tonight is exactly why serious people stay close to this channel. And subscribing to John Analyst is honestly the smartest thing you will do today. And we mean that the same way a wise elder means it when he tells you, "Son, I wish someone had told me this 30 years ago. We are that voice right here, right now." Now, a quick question before we begin. Where in the world are you watching this from right now? Drop your city, your country, right there in the comments below. Because this story we are about to tell you, it does not belong to one country. It belongs to every serious mind watching this, wherever you are. Let's get into it. And there's a number sitting inside the silver market right now that should be on the front page of every financial publication in the world. It is not. And that silence is the first data point you need to understand. 10 consecutive green monthly candles. 10 months in a row where silver, despite every attempt to push it lower, despite coordinated selling pressure, despite a volatile macro environment that rattled nearly every other asset class on the planet, closed higher than it opened every single month. That has never happened before. Not in the 1970s bull run, not during the commodity supercycle of the early 2000s, not even during the historic 2010 to 2011 silver surge that captured the world's attention and sent prices toward $50 an ounce. Never in recorded market history. And yet, turn on any major financial network right now, open any mainstream economic publication, scroll through the curated feed of any institutional research desk, you will find breathless coverage of equity volatility, Federal Reserve speculation, technology sector earnings, and currency fluctuations. Silver's historic streak? Silence. That silence is not accidental. It is structural. And understanding why that silence exists is just as important as understanding the data itself. Here is what 10 consecutive green monthly closes actually means in market language. A single green monthly close means buyers controlled the month. 2 or 3 in a row suggests momentum. 5 begins to signal something structural underneath the price. But 10 unbroken months where every attempt to drag the price below its opening level failed. That is not momentum anymore. That is a market telling you, in the clearest language price can speak, that the demand sitting underneath this asset is not speculative, it is not reactive, it is not driven by headlines or sentiment cycles. It is deep, it is persistent, and it is absorbing every single wave of selling without breaking. Think about what that requires. Over 10 months, there were geopolitical shocks. There were Federal Reserve policy shifts that sent shockwaves through currency and bond markets. There were coordinated margin increases on commodity exchanges designed specifically to reduce speculative participation. There were weeks where the broader commodity complex sold off aggressively. Silver closed green anyway, every month. That is not luck. That is not noise. That is a structural bid underneath the market that is larger, more patient, and more informed than the selling pressure being applied against it. Now here is where the story becomes genuinely important for every serious decision maker watching this. The mainstream financial advisory complex has a documented history of being the last to recognize structural shifts in hard asset markets. This is not a conspiracy. It is a business model reality. The institutional advisory industry generates its revenue from equity products, managed funds, and structured financial instruments. Hard assets, particularly silver, do not fit cleanly into that revenue architecture. Robert Shiller documented extensively in his work on market psychology how repricing events in major asset classes consistently occur before the broader public and mainstream advisory community recognize the shift. The data moves first. The narrative follows, sometimes months, sometimes years later. What we are watching in silver right now is precisely that dynamic in its early stages. The data has been moving for 10 months. The narrative has not caught up. And historically, the distance between those 2 points, between what the data is already saying and what the mainstream is finally willing to acknowledge, is exactly where the most significant opportunities for informed decision makers are found. So, the central question Part 1 leaves on the table is this. If silver has just printed a record that has never existed before in market history, and that record has been built not on speculative frenzy, but on persistent, patient, structurally supported demand, then what exactly is sitting underneath this market? What kind of demand absorbs 10 months of selling pressure without breaking? And more importantly, who is doing the buying? While the headlines look the other way, the architecture behind that answer is exactly where we go next. Forget the price for a moment, forget the charts, forget the headlines, forget every opinion you have heard from every analyst who has spent the last 2 years explaining why silver has not done what the fundamentals suggested it should. Forget all of it, and instead, look at who is not in this market right now, because that single observation, explains everything. There's a category of participant in every major commodity market known as managed money. These are the speculative funds, the momentum chasers, the trend followers, the algorithmic systems that flood into markets already moving and amplify every directional move with billions in additional positioning. When managed money arrives in force, prices accelerate, volumes explode, the mainstream media finally notices, retail investors follow, and the move that began quietly in the data becomes the story everyone is suddenly talking about. Here is what the current data shows. Managed money long positions in the COMEX silver contract are sitting at their lowest level in 20 years. Not low, not cautious, not slightly reduced. 20-year lows, lower than the positioning seen during the 2008 global financial crisis, a period when markets were in systemic freefall and capital was fleeing risk assets across the board. Lower than any point in 2 full decades of market cycles, bull runs, corrections, and recoveries. And silver just moved 16% off its weekly lows. 16%. Without them. Pause on that for a moment because the strategic implication is significant. Every serious market participant understands that the largest, most sustained price moves in commodity markets occur in 2 distinct phases. The first phase is structural, driven by fundamental supply and demand imbalances, by patient institutional accumulation, by central bank positioning and physical market tightening. This phase tends to be slow, persistent, and largely invisible to the mainstream. The second phase is when the momentum capital arrives. When the managed money funds, sitting on the sidelines, watching a market move without them, finally capitulate to the trend and flood in with leveraged long positions. This phase is fast, visible, loud, and dramatically accelerates the price moves that the first phase quietly built. Silver is currently deep inside the first phase. The 16% weekly move happened with speculative positioning at a 20-year low. The momentum crowd is not here yet. They are watching from the outside, cautious, waiting for confirmation signals that fit their systematic entry models. When they arrive, and historically, in a market with this structural profile, they always eventually arrive, they will be entering a market that has already absorbed 10 months of selling pressure without breaking. They will be adding fuel to a fire that has been burning quietly, steadily, and with remarkable discipline for nearly a year. The move that already happened will, in that context, look precisely like what it is, the opening act. But speculative positioning is only one layer of the architecture. The foundation beneath it connects to something that operates on a far longer timeline than any trading fund's quarterly mandate. The US dollar's share of global reserves has just hit its lowest level in 32 years, now sitting at 56.9%, down from 72% at its peak. Central banks across the developing and developed world are not reducing dollar exposure because of a newsletter recommendation or a short-term tactical call. They are doing it because U.S. debt trajectories, persistent structural deficits, and long-term credibility erosion have made the shift not just logical, but unavoidable. And when central banks move, they move into gold first, always. But gold and silver do not operate in isolation. They share a monetary heritage, an industrial supply structure, and an investor psychology that links their long-term price trajectories in ways that intermarket analysis makes visible. Central bank accumulation of gold at 610 tons per quarter, running 230 tons above the historical threshold that drives approximately 3% quarterly price appreciation, is not just a gold story. It is pressure building inside a connected system, and silver sits directly inside that system. There is one more layer to the architecture that most analysts are not connecting publicly. China reopened after Lunar New Year, and the first thing that emerged from ground-level reporting was not a surge in buying. It was something far more telling. Multiple gold shops across the country stopped selling bars entirely. Contracts signed before the holiday were not delayed. They were refunded. Sellers handing money back rather than sourcing the metal because the metal was not available to source. A physical delivery failure. In the world's largest gold-consuming country. At the precise moment that silver's speculative positioning sits at a 20-year low and the dollar hits a 32-year reserve share bottom simultaneously. These are not 3 separate stories running in parallel. They are 3 pressure points on the same structure, loading in the same direction at the same time. There is a specific moment in the history of every major financial disruption where the data was already visible, where the numbers were already speaking, where anyone looking carefully, without the filter of institutional optimism or mainstream narrative management, could see exactly what was coming. That moment is not after the crisis. It is not during the crisis. It is in the quiet period before, when everything on the surface still appears functional, when markets are still moving, when confidence still exists in the official language of policymakers and financial commentators. We are in that period right now, and the fault lines are visible to anyone willing to look directly at them. Begin with a number that has received almost no serious mainstream coverage, despite what it represents. The United States pending home sales index has just printed an all-time low. Not a multi-year low, not a post-pandemic adjustment, not a cyclical correction within a broader healthy market, an all-time low. Down over 43% from its peak, contract closings falling more than 8% in a single month. The housing market, historically one of the most reliable indicators of broad economic health, consumer confidence, and credit availability, is not slowing. It is frozen. Now understand what a frozen housing market actually signals beyond the real estate sector itself. Housing transactions are the engine of an enormous downstream economic chain. Mortgage originations, title insurance, home improvement spending, appliance purchases, moving services, furniture retail, all of it contracts when housing freezes. But more critically, for what we are watching in metals markets, a frozen housing market is a credit market telling you something about its own condition that it cannot say directly. When credit flows freely and confidence is high, people transact. When credit becomes quietly restrictive, when lending standards tighten beneath the surface, when the cost and availability of debt begins to shift in ways that have not yet appeared in official statements, housing freezes first. It is the earliest visible symptom of a credit system under internal stress. And the credit system right now has more than one symptom showing. Here is the fault line that should be in every serious economic briefing being delivered to every major institution in the world right now. There is a $2 trillion private credit market that has been quietly and systematically funding the build-out of artificial intelligence infrastructure. Data centers, computing capacity, the physical backbone of what the mainstream has collectively decided is the most transformative technological development of this generation. $2 trillion, deployed predominantly into illiquid structures, meaning the capital cannot be easily or quickly withdrawn when conditions change. Deployed into companies carrying extreme debt loads to build infrastructure that, by its own financial logic, may not generate meaningful cash returns for several years. Deployed by pension funds and insurance companies, institutions managing the long-term financial security of millions of ordinary people, into structures whose liquidity assumptions were built on a continuity of conditions that is now beginning to shift. One of the key lenders operating inside this system manages approximately $273 billion in assets. It recently restricted withdrawals from a $14 billion retail fund. When a fund of that scale restricts withdrawals, the market asks one immediate question. Does this fund have sufficient liquidity to meet its obligations? And that question, once asked publicly, does not stay contained to the fund itself. It migrates. It spreads through the interconnected network of private credit relationships, leverage structures, and institutional confidence that the entire system depends on to function. The withdrawal restriction has happened. The question has been asked. Now place these two fault lines, frozen housing and private credit stress, alongside the third signal that completes the picture. Gold's volatility has just hit its highest level since the global financial crisis. Not elevated, not above average, not slightly concerning, the highest since the financial crisis. In market language, volatility in gold is not simply a measure of price movement. It is the market's mechanism for pricing tail risks, the low probability, extremely high consequence events that do not appear in base case economic forecasts, but are visible in the data to anyone reading it carefully. When gold volatility reaches crisis era levels, it means that the informed, patient, long-duration capital that positions in gold is pricing the real possibility of systemic stress events that have not yet fully materialized on the surface. They are not reacting to a crisis. They are anticipating one, and they are moving capital accordingly. Right now, before the mainstream narrative has caught up to what the data is already saying. This is the precise dynamic that serious decision makers need to understand about this moment. The three fault lines, housing frozen at all-time lows, private credit showing early liquidity stress, and gold volatility at crisis-era highs, are not independent anomalies occurring by coincidence in the same quarter. They are the same underlying stress expressing itself through three different systems simultaneously. A credit system under pressure always speaks in multiple languages at the same time. It speaks through housing transaction volumes. It speaks through fund withdrawal restrictions. It speaks through the volatility surface of the assets that informed capital historically runs toward when systemic risk begins to rise. All three languages are being spoken right now, simultaneously. And here is what this means specifically for silver. Every major period of systemic financial stress in modern market history has ultimately accelerated the rotation of capital into hard assets. Not immediately, not in a straight line. The initial phase of stress events typically produces sharp, indiscriminate selling across all asset classes, as leveraged positions are unwound and liquidity is raised. But the second phase, the repositioning phase, where capital that has been liquidated from stressed structures seeks a new home, has historically and consistently found its way into gold and silver, with a velocity that surprises everyone who was not already positioned. Silver sitting at 20-year speculative lows, with 10 consecutive green monthly closes already behind it, with physical delivery failures already visible in the world's largest consuming market, is not waiting for that rotation to begin. In ways the data makes visible, it has already started. Everything covered in the first three parts of this analysis was not history. It was not theory. It was not the opinion of any single analyst, commentator, or institutional research desk with a conflict of interest embedded inside its revenue model. It was data, current, documented, verifiable. And data, at a certain point of convergence, stops being a collection of individual signals and becomes a single, unified argument. That argument is now complete. And the only remaining question is the one that separates serious decision makers from everyone else watching the same information and doing nothing with it. What do you do with what you now know? Start with the divergence that intermarket analysts have been watching quietly for months, because it carries more forward-looking information than almost any other single data point in this entire analysis. Silver miners, the publicly traded companies whose entire business model is built on extracting and selling silver, are currently sitting only 14% from their all-time highs. Spot silver itself remains 44% below its nominal peak. Pause on that gap. Because in intermarket analysis, when equity markets begin pricing in future metal values that spot prices have not yet reflected, it is not a coincidence or a sector anomaly. Equity markets are forward-looking instruments. The companies that mine silver are being valued by institutional capital as though significantly higher silver prices are already coming. The stock market is telling you what the spot price has not yet said out loud. And historically, when that divergence exists at this magnitude, when miners are this close to all-time highs while the underlying metal remains this far below its peak, the gap does not stay open indefinitely. One of two things closes it. Either the miners come down to meet the metal, or the metal rises to meet the miners. Given everything documented in parts 1, 2, and 3, the physical delivery failures, the 20-year speculative lows, the dollar at 32-year reserve share bottoms, the private credit stress, the frozen housing market, the crisis-era gold volatility, the direction of that resolution carries a weight of evidence that serious decision makers should not dismiss lightly. Now address the resistance case directly. Because intellectual honesty is not optional in serious analysis, it is the foundation that makes everything else credible. Gold at $5,098 with crisis-level volatility means sharp, fast, deep pullbacks can occur at any moment without any change in the underlying fundamental picture. Markets running at elevated volatility are markets where moves in both directions happen with speed and severity that catches unprepared participants off guard. Silver's 16% move off the lows has created a layer of short-term traders sitting on open gains. Those participants will exit into any credible negative headline. A hawkish Federal Reserve statement, a stronger than expected dollar print, an equity market relief rally that temporarily reduces safe haven demand. That exit, when it happens, will look alarming to anyone who entered without understanding the structural thesis beneath the price. The private credit stress, while visible and documented, has not yet produced a publicly visible bankruptcy event of sufficient scale to force institutional repositioning. Until that event occurs, large pools of institutional capital may remain allocated to risk assets rather than accelerating rotation into metals. And silver dropping from elevated levels, even sharply, while still closing green on the month, is not a thesis failure. It is the thesis operating exactly as commodity bull market history says it operates. Jim Rogers documented this dynamic with precision. Violent corrections inside structural bull markets are not reversals. They are the mechanism by which impatient capital is removed from the trade before the next leg higher begins. The structure holds, the conviction of the unprepared does not. Understanding that distinction in advance is the entire difference between being shaken out at the worst possible moment and holding through the noise with clarity that cannot be argued away. Here is what the complete picture looks like when every layer is placed together in the same frame. A metal printing a record that has never existed in market history, 10 consecutive green monthly closes, while speculative positioning sits at 20-year lows. A physical delivery failure in the world's largest consuming country, occurring at the precise moment that dollar reserve share hits a 32-year bottom. a $2 trillion private credit market, showing early liquidity stress simultaneously with U.S. housing freezing at an all-time activity low. Gold volatility at crisis-era highs, while silver miners price in a future that spot silver has not yet reached. These are not separate stories. They have never been separate stories. They are one story, told across multiple asset classes, multiple geographies, multiple financial systems, all pointing in the same direction at the same time. The informed minority already understands this. They understood it before the 10 consecutive green closes were complete. They understood it when managed money was fleeing and the mainstream was explaining silver away as a tariff noise trade. They understood it because they were reading the data, not the headlines, not the sentiment, not the curated narrative of an advisory industry with structural reasons to look the other way. For the business community watching this analysis, for the entrepreneurs building companies and managing capital in an environment that is becoming increasingly complex and increasingly unforgiving of uninformed decisions. The strategic question is not whether silver will move. The data has already answered that. The strategic question is whether you will be positioned with clarity and conviction before the mainstream narrative finally catches up to what the numbers have been saying for 10 consecutive months, or whether you will be reading about it afterward, wondering why you saw the data, understood the argument, and still waited for permission from a system that has never had your interests at its center. Markets do not wait for consensus. They do not pause for comfort. They do not reward hesitation dressed up as caution. They reward preparation. They reward the discipline to read what is actually there, not what is comfortable, not what is convenient, not what fits the narrative that requires the least courage to hold. Silver has been printing that message in green for 10 consecutive months. The data told the story. Most did not notice. You just did.